Welcome to the Stop Group. Today is Saturday, February 12th. And we're going to take a look and see what the market did this week, starting with the Dow. So Monday and Tuesday, the Dow was kind of flat. Monday was kind of a flat day. Even Tuesday and Wednesday were two good up days, but gave it all back Wednesday and Thursday. News came out. I think the CPI came out on Wednesday or Thursday, and it showed a lot of inflation. So the market rolled over for the Dow. As it relates to the NASDAQ, NASDAQ was down Monday, had two good up days, Tuesday and Wednesday. But when that inflation data came out, down big, well, kind of down a little bit Wednesday, but it was up much higher Thursday, and then a huge down day on Friday. For the Russell, and actually this is, you can see Russell was coming off of these lows, had broken that downtrend, got the confirmation. And so Monday, Tuesday, and Wednesday was good. And then you can see this huge candle here with the wicks on Thursday and then down on Friday. S&P overall, pretty much the same. Down Monday, up Tuesday, Wednesday, down big Thursday and Friday. This is a large candle here. So that was not good. Let's look at some of these individual names. Let's see who else just joined. Hey, Brand, how are you?
I'm good, Mike.
So let's see. Let's look at some of the big names. Look at Apple. So you can see here, Apple coming off of these lows back in January, and this week pretty much followed exactly what the NASDAQ has done. Two big down days, Thursday and Friday. See, Autodesk got killed Thursday and Friday. It's a huge candle here on major support here at this 227 on Autodesk. Wow, it's crazy. Let's look at Aegon. Aegon actually came out with earnings. They did decent on the earnings, but I think the guidance came in lower, and I believe they had maybe larger death benefit claims, and so they got hit. So they were up in the sixes and they dropped down. So I don't know how much percentage you can see. How much did they lose on that? Initially down 7%, and then the next couple of days the market was down. So about a 10% reversal there. Let's see. American Tower. This is a cell phone tower company. They're coming back close to those lows that we hit January 28th. So they're getting down back to the support 232. Let's look at Amazon. Amazon came out with great earnings, but you can see pretty much everything was down on Friday. So, but right here, Amazon is broken out. Let's see if they can hold here. This week is going to be interesting. Actually, I can't wait till March to get here. So the Fed go ahead and make this first rate adjustment. And I think the market is going to get a sense. I don't know if they're going to do 50 basis points or not, but whatever they do, I want them to hurry up and do, because this volatility in this market is crazy. APPS has done pretty well. You can see they bucked the trend this week, where you had 3 days kind of down in overall markets, where APPS, they've only had one down day, and that was on Friday. Thanks for those that just joined in. AQB. This is one that's interesting here. They got down to the lows of 153. You can see here, and even a little bit lower, 152. But, you know, they got 4 straight down days. And if you extend this trend here, so you can see they broke up. You got a little confirmation here, but you can see they're falling back down below this trend, coming toward this support level 153. Let's look at Cathy Wood ARC funds. You can see they were all bouncing off the lows from late January. Pretty much all look the same. But you're going to see pretty much on most of all these charts, either Thursday or Friday down, or Friday down specifically, last bar. So all of those coming off the lows in January. Let's look at Boeing. Boeing actually, you can see off the January 28th lows, Boeing was doing real well, but like I say, yesterday was just a down day for everybody. So Boeing was up to 121. So you see how big this reversal was. They were at 121 in a session and closed down to 112. So that's almost 3% to the downside. That's brutal. Well, and that's just from the previous day, but yeah, they gave up a lot on there on Boeing. Let's look at a couple other names here. Let's look at the banks. So Citigroup been doing well off of these January 24th lows. Like I say, everything again, you can see this Friday move. So this inflation stuff is killing. So they were down almost 3% in the session. Let's look at JP Morgan. Off the lows, going up, pull back Thursday and Friday. So that's pretty much the same kind of pattern in most of these. Let's see. Let's look at Goldman Sachs. Goldman Sachs pretty much off of the lows, doing well, but then pull back Thursday and Friday. So I think we're going to see that pattern repeated in a bunch of these charts here. Let's look at lows. If you go back here, you can see lows coming back all the way to August. Had a huge run from 183 up to 262. And you can see here lows is in this box, this range here from right here from what is that, 238 to like 222, so about a $16 range. So it actually looks pretty decent here because it looks like Lowe's is just trying to build a base to the side here around this 125, 122 area. Let's look at what Home Depot is doing in relationship to that. Pretty similar. Their box is a little bit wider, but still. So if you take say probably here to here, so you can see Lowe's. I'm sorry, Home Depot. It's kind of in this trading range sideways as well. Let's look at McDonald's. McDonald's had broken out well, but McDonald's started having trouble last week. And you can see here, they've just, specifically this week, the whole week it was down. So you can see here, they're giving up a good bit of gains. It's about 8 points. It's not too bad. 8 points from off the highs, and bounced off these lows of January 27th and started a uptrend here. So, again, depending upon what this market is going to do overall, just can't wait for the Fed to go ahead and raise these rates so we can digest this and try to get some stability. Let's see, anything else? So here's an interesting one. Shopify has been getting just absolutely murdered. But you can see that We're in this base here though. It's a pretty wide base, 191 to 890. I can't even talk. 989 to 809. So, but still just going sideways here. As long as we can hold this 813, 800, a little bit lower here at 781. So it's going to be interesting to see what happens with Shopify. And I think this is a heavily shorted stock as well. Let's check on that. If you want to look and see just kind of short interest on stocks, you go out to the site called FinViz, put in a ticker, and it gives a lot of different statistics here. So you can see short interest. Shares outstanding, so it looks like 2.1% float on the short. Thought it was actually going to be a little bit higher than that. Yeah, so okay. All right. Let's look at T-Mobile. Not T-Mobile, AT&T, I'm sorry. You see AT&T in this box. AT&T came out, they cut the dividend. Is what this big red bar was. So that dividend cut was anticipated for a while. It just took them a bit of time before they actually announced it, but they finally did. But you can see AT&T is holding here at this 23 level. Just kind of see them going sideways. So that's interesting. Let's look at UPS. Wow. So UPS came out with earnings here January 31st. And pretty much since then, just kind of been pulling back pretty hard. And then this week didn't help at all because you can see Wednesday, Thursday, Friday, it gave up a pretty decent percentage here. Let's see, just in 3 days, lost 7%. So it's a pretty quick rundown of what some of these names are looking like, how they're doing. And again, this Fed news is the inflation news, and then the Fed's response is really just causing a lot of instability in the markets. I'll pause there. Any questions? Thanks for everybody getting on. Let's see what we got. Barry, David, Milton, Lorenzo, and Brand. Any questions, comments? Bueller?
Nope.
All right. So let's see. Let's see here. So one of there was a member that wanted to ask wanted to talk about some long-term kind of prospects in the market. So a lot of times we go through the charts, we talk about these specific names, but let's see, and I have a list here. I'll show you. So I put this list together. I think we talked about it maybe a couple sessions ago, just in terms of some of the better companies and having more of a long-term perspective. So you can see, let me go back to the S&P. All right. So let's go to a weekly chart here. All right. So you can see if you take let's look at 5 years, 22, let's go back to 17, right? So you can see here, having a long-term perspective, you can see how much the S&P has grown. Now, given, we're coming off these lows, back in 2008, the last real, the correction before the Corona. That's our last, big correction. It's 2008, 2009 financial crisis. And then here you see the Corona pandemic lows here, and then up. But just overall, when you take this long-term view of the markets, you can kind of see here it's a little bit different. So, but if you take this long-term view, if I just draw this trend line, you can kind of see it. But if I just draw this trend line here up, you can see that, hey, that it's just trending up and to the right. And then if you draw this trend line as a steeper, kind of a steeper angle here, you see it is went up even much more. So this long-term view here is definitely one that you want to keep in mind. So let's say, here's some of the names that I look at in terms of some of the longer term good companies, good balance sheets, revenues, have earnings, as opposed to some of these stocks don't have any positive earnings, and they're just good bellwether stocks. So got Apple. So again, let's just look back. Let's go 17. You can see here, long-term view on Apple has done well. Let me move some of this stuff off this chart. ADSK, again, 2017, more of a long-term. So you all can see the list here. Get some more participation. From a long-term perspective, what companies are you all looking at or would consider in terms of a long-term view that I may not have mentioned in this list here, and I'll add them. So give me some names, please. Y'all gonna have to come off mute this morning. I need some participation.
Walmart, man.
Walmart. All right, thank you. Appreciate it, David. I'm gonna start calling names. We up in class here now. Call names and get to the board. Let's see, Walmart, Wally World. Let's see. Okay, Walmart. Yep, long-term perspective.
On that same vein, I was going to say Target.
Target. Okay. Cool. Let me add those to the list. Walmart. Let's see. What's Target? Let's add them to the list as well. Target. Any others? Let's see. Okay, here. All right. Okay, Walmart and Target. Let's see who else. One I like that's already on the list, but look at Costco. Costco has been rocking. Take this long-term perspective. One I don't have on here, and they've done pretty well, I believe, is American Express, APX. So you can see here, taking a long-term perspective. So mark that one.
What are your thoughts on adding a cruise line?
I wouldn't. I don't know if I would. I don't really look at a cruise line as a long-term hold. Not to say that it wouldn't. I don't think I would have considered a cruise line. But, and let's see. So if you look here, so this is Carnival. So off of these 2008, 2009, that was a nice run from where it was. But really, you can see here, this is even before pandemic. Starting in February of 18, you just got, a huge correction, and then the pandemic hit, and then it was just game over, right? So now, considering where we are in the so let's look at what's the other Norwegian cruise. Trying to get a sense of, so in these cases, Brand, I don't really, so here you had Carnival was much better, but even here, this before pandemic, you just really range bound here, right? So if you take that and you compare this, look at a Microsoft, for instance. Yeah, two very different charts. You see what I mean? From a long-term perspective. So I would not consider this really as a long-term hold. Now, can it be a good trade, particularly where we are, given that they're, if you go from where they are in the highs to where we are today, they're down 65%. This might be a good trade at this point, but in terms of building, we're in 22, you're saying maybe look out 10 years from now. I would go with some of these other names here in my red list, versus Carnival or Norwegian. And I'm not sure what was it, Carnival and Norwegian really can't use Disney, because Disney is they got so many other things in their business. Their cruise part is just a small part of their overall assets. I don't even know the other cruise lines other than Norwegian and Carnival. I'm not even sure what's the next biggest one from there. Let's see. Let's look at Home Depot. Again, taking this long-term perspective, right? You can see here, they've been running well since 2011. Lows, pretty much the same. MasterCard as well. Here's an interesting one. Nike has done very well. So let me ask, how many of you have some of these names in your long-term portfolio, and or do you have a long-term portfolio? Let me start there.
No, I don't have a long-term portfolio.
Okay, no long-term. All right, I'm gonna start calling names. Let's see. Milt, I know you have a long-term perspective.
Of course I do.
Yes, sir. What you have in your long-term stuff that you don't really trade, but you hold?
Okay. I am a different type of investor than that. I think Brenda knows what type of investor I am, because she probably invests in the same thing.
Okay.
All that nice, newfangled, exciting stuff. Where's your banks?
Banks.
Where's the Procter and Gamble? Okay. Chevron.
Say who?
Chevron.
Oh, Chevron. Oh, is it CHV? Okay, Chevron.
You like Chevron better than Exxon?
I don't invest in any of those. I just threw that out there. Here's the deal. I got to hug my trees, so these are not for me. But if you're a serious investor, you probably have that. Look at that chart, Mike. Would you think that this is a good thing to buy?
No, I don't like Chevron. I mean, if
chart wise, just
chart wise. Okay, so if you not from that, and let me explain why. So if you let's just chart this up, right? And we've saw a bunch of other charts here. All right. One of the things that I would say is, in those other charts that we looked at, we didn't have We didn't have this much pullback in those charts that I showed before. So if you take just look at a Nike, we got the pandemic one, but so you can see the degree of the scale. So let's just measure it. So we just go pandemic low, right? So pandemic low to high, talk 194%, right? You go back to, what was it, Chevron. Here you're talking what, a little bit over about, I guess it's decent, but that growth that's up here is just, so if you take, so now off of the pandemic lows, this was definitely a good trade. But if you let's move this to the right, let's take that pandemic low out, right? And you see from here, yeah, it's going up. I'm sorry, I didn't mean to click on that. It's going up. However, you got some huge pullbacks in this thing. I mean, so if I measure each one of these, so we can see where we have the ascending trend lines, but you measure each of these pullbacks. All right, that's a 43% pullback, 35% pullback, and then you got another 43% pullback. I wouldn't buy this. Just me.
Okay.
I wouldn't.
Let me tell you the missing part of this. And
Okay.
it's what I've been hammering just about every time I have come on about investing long term.
Mhm.
You see all these pullbacks?
Yeah.
This is not oh my God. This is, oh my God, I get some more Chevron now. Now, could you pull this up in Yahoo?
Pull it up in Yahoo. Okay.
Yes, Yahoo Finance.
Mhm.
There's just one thing I want you to see, the difference between that and Nike. Look at the dividend.
Well, yeah, I knew you was going there on that. That's why I looked at it.
You knew exactly what I'm going
4% yield, right?
Yeah.
All right. So yeah, so got a 4% yield.
All I'm doing is every one of these downturns, I'm not doing this on this one, like I said, I got to hook my trees.
Okay.
I'm buying more of this, and that dividend, when I retire, is going to be paying me until I croak off.
Okay.
So every dip, I own more Chevron. The cost, believe it or not, does not matter. It's how much it's giving me and how much stock I can build up to get a better dividend payout.
Okay. So let's see. Yeah. So in terms of these dividend names, now go a little further there, Milt, for the benefit of everybody. So so on your dividends, just kind of explain that a little bit for those that may not know these dividends.
There's a reason that Wall Street buys stocks. They buy them with the idea that I'm going to get paid off at some point. And that's what I think a lot of people who are new don't understand. There is a payout. This is not electronic. There is an actual piece of paper where you own part of this company. And your thought is that this company is going to give you your money back at some point. And that's what anything you buy as an investor, there's a thought that I'm going to get my money back. Chevron gives me part of my money back every, I forgot what their cycle is, but I think probably every 3 months.
Okay.
So I'm getting my money back. I'm not just putting money into a black hole and hoping it succeeds. I'm going to get my money back. That preferred I was telling you about, every quarter it gives me my money back. And what you saw, that 7% return, I bought it when it dipped, and I get a 17% return on that. The only bad part about that, I'm sorry for the people who weren't around when I was showing Mike one of my real long-term holding. I bought this during the financial crash. It was Wells Fargo. And it's really not a preferred, it's more like a coupon. But I don't want to get too deep in that. That's why I just call it preferred, so it's easy to understand. And the ups and downs of that stock, it's meaningless to me. What I'm interested in is the money that it gives me back every quarter. And if you do a 17% over about a decade, you'd have made a lot of money. My only drawback is I was a little time guy and I didn't have enough money then.
Yes, sir. So one of the other things is that, and Milt, I'm quite sure you probably reinvest your dividends as opposed to just take the cash and do something else with it, correct?
That's where I'm different. I take the cash and do something else with it.
Okay. All right.
Here's what. I also like to trade, and this is what allows me to trade. I remember when I said, duh, why did I put money back in there?
Mm-hmm.
The reason was I was putting money in more exciting things, like buying Apple. And that's the difference, investing, trading. Apple is actually a trading vehicle for me, and it has been over time.
Okay.
I own Apple right now because, of course, it's still doing well. But it was sort of like, anytime there's some type of, oh my God, the world is ending, I go buy some Apple.
Good. So, so I think to that point, that long-term dividend strategy, it does give you back. So if you say, so you're talking 4%. So if you take $1,000, was that 4%? Was that $400? Every year, and you get that dividend back. Like Milt said, he takes that $400 off a $1,000 investment, and then was that $40? No, $40.
Yes,
$40. Sorry,
don't I wish?
Right, $40. Sorry, that $40 off of that $1,000 investment, and then he used that to fund some of the trading and the other stocks. And so, I would definitely say on those dividends are good. And like I said, that long-term perspective. So even if you look at a Nike, right? I think Nike has the yield is not, so in comparison, so you can see here, Nike has a 0.87% yield. So this is, less than 1%. Whereas what Milt just showed on that, let's look at that Wells Fargo again. Wells Fargo is 1.7, but on that preferred, I think you said it was 17% on the preferred. So
yes, when I first bought it.
When you first bought it, okay.
Yeah, this is sort of a different creature, but it was 17% when I bought it.
Okay. What is it at now? Do you know?
It is at 7% now, but
okay,
it doesn't matter because it's still 17% for me.
Okay.
My original investment.
Okay.
It's just that it goes down as the stock price goes up.
Okay. Good. So dividend plays are definitely good. One, there was one this guy told me about a long time ago, and I used to hold it, but I have it anymore. I don't know why my dividends are not showing. 1 second. Let's see. I thought they usually show. I don't know why they're not showing dividends on this chart. But this AGNC, so you can see this yield. This has a 10% yield. So this is a REIT, real estate investment trust stock, and they pay out monthly dividends, and they have an annual yield 10% here. And so this is definitely one that you can use. Let's see. Let's talk about that AT&T. AT&T pays dividends as well. You can see their yield is 8.6. So there's, I think I looked at it once before. Let's see, long-term dividend stocks. You see what Motley Fool are saying about some of the best ones. So, all right, so say Lowe's. We talked about Lowe's just as a growth stock, but you can see that, dividends. So the average is on 34 years old. So Lowe's, Wall Street Boots Alliance. Haven't heard that before. I mean, I've heard of Walgreens, but not the Boots Alliance. Maybe it's just a full name of the company. Realty.
It is. I think they bought something, and that's when it became.
Oh, they changed the name. Yeah, let's
I can't remember what they bought, but it was something big.
Okay, let's see. Walgreens, not Wall Street. So you can see here they got a 3.29% yield. Let's see. Haven't heard of O. Let me look at O. Realty Income. I don't think I've ever heard of that company before. Let's see. Ticker O. All right, 4.38% yield. Okay, Brain, you just mentioned Target. Let's see what Target's yield is. Target 1.7. So you can see you got a pretty wide range from the, less than 1% Nike, 1.7 here on Target. That 4 point something that we just saw on, so definitely you can add to this. And now I don't typically trade my dividends. I usually just take my dividends and I reinvest them back in. And so that's my preferred method for it. And that
is the wisest method too. Let me just throw that in.
Yeah, but I don't hold dividend stocks long enough. I probably play too much growth and don't stick out like this, like that AGNC. I've been knowing this for a while. AGNC. And like I say, this company pays out monthly, and you can see the yield that they have on this, right? And actually, if you look here now, this might be pretty decent because they're coming off these highs, and you can see with this pullback that we're in, so they're 21% down, right? So had you bought it here and was getting the dividend, your dividend will be much, from a percentage perspective, it would be much lower than what it is now if you bought it at this point and was still getting that same monthly dividend, because the dividend is based upon your entry price, right? So AGNC is one to take a look at there on the dividends. But also one of the things too, so like what I don't have on this list is look at Google, right?
Mike.
Yes.
Really quick, usually they give a dividend on the share. You write the percentage is the same, but the reason I want to make sure that I pointed that out is to explain why in companies like these, I'm interested in how many shares I have and not necessarily the price.
Okay. So, well, in that, so you look at the number of shares. So like, so you take a Chevron. So, well, but given that, so let me ask you this, Milt. So if you take a AGNC, right? Just as an example, you got a pretty juicy yield here, right? But the stock is cheaper. So, if you took that same $1,000 investment, right? You can always add zeros to the number. Take $1,000 investment with it at 14, 12. So you're talking about you can get 70 shares. So if you got 10 grand, you get, 708 shares, So you say 708 shares there. And particularly if you're reinvesting these dividends, so you say 10% of that. So if you say you're getting a 10% yield, so what you're going to get about 70 shares extra a year. on that. You see what I mean? At 10%. So, you're going to be growing your number of shares. So if you had 10,000, you add 700, 10%. Yeah, we add another 70 shares to that. So you're going to have 10,070 shares that first year if you're reinvesting your dividends, and each year, that number will increase. So, versus if you went with like you say, if you did the Chevron, and I can never keep remembering this darn ticker, CVX. Okay. Versus a Chevron, if you took that same $1,000 and 136, you're talking about you can only buy 7 shares, right? And so your dividends are paid out based upon the number of shares that you have. So if the dividend payout is 4%, whatever 4%, the actual, I think it was $5 and some change. So you take $5 times 7.35. So that's what your amount would be. So 7 times 5, so $35 a year is what you would earn on this if you own 7 shares of Chevron, where it is now. But but again, if you took that and you bought the AGNC, I just say you had 86 shares, right? And then they gave a 10%. You got a 10% yield on that. So you're talking, you'll be earning, an extra 100 shares or so a year with your dividends reinvested. So for that, if you're just looking at getting more shares out of that, a cheaper price stock would be better. Now, just because it's cheaper, one of the things you got to look at and see is how long and how stable the dividend is. So you have to do a little bit of research there as well. I think Nike pays a dividend. Let's see. Yeah, their yield is much cheaper though. You see at 0.87. Let's go back to that Lowe's. I think showed in the list. So Lowe's is 1.42. So even comparing Lowe's just to Nike, just as a comparison, you can see that the Nike dividend is half of what the Lowe's dividend is based on the yield, right? And the yield is nothing but the amount of the dividend divided by the stock. That's all yield means. So it's not so any other questions on this dividend perspective? Now let me ask you. So David, I know you said you don't have a long-term perspective on stocks. What about some of the others? What are you all holding long-term?
I mean, I got 100 million Shiba Inu coins, and I got 216 million Ryoshi coins. I got some Ethereum. And I had stocks, man, but I just got rid of a lot of them when I had made some money on them, and then it just turned in my favor that everything dropped, so I didn't have anything to lose, and I just haven't put anything back in there. So that's kind of where I'm sitting right now.
Okay, yeah, and so David's been playing more of the cryptos, and so those what he just named were cryptocurrencies, and in those they're volatile, so you got to trade with them. But having a big number of them that he mentioned, he's looking for those to. And one of the things is that, so we saw, if I go back to the S&P here, just show this, and probably the Russell is maybe even better. So crypto market has been following the stock market. So you can see here on the small caps Russell that they've pulled back. But if you go and look at, I'll just use Bitcoin as well. If you look at Bitcoin over the same time frame, so you see Bitcoin topped out in November. So it's really following what the Russell has done. And it, so you say this pullback here from, about a 51% pullback as BTC. Now let's compare that to the Russell. Measure that out. It's about a 21% pullback. in the Russell. And that's just the index. The individual names that were hit much harder. So if you had any small caps. And so it's just pretty ironic that the crypto market has followed what the equities market has done. And so when we kind of bottomed out here in, January 24th or so, if you look at most of these indexes, what's that? January 24th on the S&P, January 24th on the NASDAQ, Russell, January 24th, and then the Dow, January 24th. So that was a low for all of those indexes in addition to cryptocurrency. So, so interesting bit there. Let's see. So given that we've had this pullback in these, what are you all adding to your portfolio? Or let me just ask the question a different way. How many people are scared and they're not buying anything right now because of the pullback?
Mike, I would put that a different way. How many people are just being patient right now while we're having a pullback?
Okay, that's fair. I can take that. Bueller, is this thing on?
Hey, I'm at work, Mike. Yeah,
okay.
I'm being paid. Just walk. Just there.
Okay. So you just sitting on the sideline, Barry?
Yeah, I had invested. What was that? Last week.
Mm-hmm.
Yeah. Disney's earnings came out. It went positive. Overnight, then that morning stuff was just selling off because the SP the futures was down. Was that Wednesday? I think it was Wednesday.
Yeah.
I was probably up. I was up probably like I'm trying to make income. I'm not really doing it for the long term.
Well, actually, Barry, the conversation that we just had about these dividends, that would seem to appeal, I think, to you in terms of, you're trying to generate income. So looking at some of these stocks that pay, those good dividends, you can use that to get, and particularly like some of those that pay quarterly or even the ones that pay monthly, you can use that, put that money there, and then just use that. The yield is almost like, collecting rent, you know what I mean? So,
right.
So it might be something you want to look into, knowing that's kind of like your investment style.
Right.
Yes, sir. I could say during this pullback has been brutal for me because I hold a bunch of tech stuff. I've rotated out of several things in this correction in the Russell. I had a lot of small cap stocks, so I got killed. My portfolio did. However, I understand that this is that some of this innovation stuff, and this is just my personal opinion, so don't take this as investment advice. But I believe that some of these things are they're, once we get to this, we're going to be in a different interest rate environment. But productivity will always win. It's just a matter of time before it adjusts. But a lot of these innovation stocks, they're taking advantage of automation, technology, in order to make processes and stuff more efficient. So a good bit of these things that I own, they're down huge, but I have some resolve to know that, hey, over time, I'm taking more of a long-term approach of it. Over time, I think they're gonna come back. So you look here, right? And I wouldn't necessarily call this an innovation stock, but so one thing we talked about a few weeks ago, and I wanted to discuss is what is it that right? So let me just bring this up. Just start a little piece here. So we say in terms of what do we know? All right. So interest rates, will increase, right? We know that, right? So it's something that we know. So as a result of that, what, banks, and I'll say the good banks, they do better. Also in their financials, just banks is a financial, but financials include things more than banks. They typically do well, better in a interest rate environment, right? So what else we know? We say that stocks have corrected. All right, so that's just something that we know, right? Let's see.
There's another thing we know that I hope people are playing, and that is the tension with Russia and Ukraine, which is making energy costs elevated. So this is a good short-term trade. And notice I said short-term.
Okay. All right. So you can say Russia, Ukraine, and why that is important is that I think that oil, I know Russia sits on a lot of reserves. Is Ukraine pretty oil rich as well? Milt?
I don't think they're more of a pass through. In other words, from Russia to Europe. Okay. I don't think they're very big in that sector. Okay,
so they can mess up the supply chain provided that there's a war. Is that the thesis?
No. The thesis is that if they go to war, the Western country is going to sanction Russia in their energy.
Got it. All right.
A little off topic. Normally, you don't start wars in the wintertime because it's stupid. But if you're supplying your enemy's friends and allies with energy, and it's wintertime and you know they need it, hey, perfect timing.
That's pretty funny. I mean, not funny, just, I don't know, probably bad humor funny. But yeah, that's interesting. I didn't even think about, wars in the winter. All right. Just energy, I'll just say energy concerns. I'll just say that. That's fine. Inflation. So with inflation, we know that, the cost of money will increase. Where this comes into play is growth stocks typically pull back in a higher interest rate environment, right? Because a lot of times they use cash a lot, and it could be cash in their operations, cash in their investment portfolios, and also access to credit, right? All right, so these are just things, and so when you look at that, you say, okay, and then I guess another piece of that is mortgage rates increase, right? So that makes housing more expensive, right? So these are outgrowths of kind of this inflation in terms of things that Now, how can you take this information and then use inflation, to your advantage? It kind of goes back up to some of these things here. Interest rates are going to increase. It's going to be good for banks, good for certain financials, insurance companies particularly. Mortgage rates increasing. Now, this could actually slow down depending upon how high these rates increase. It could slow down the accelerated cost of housing. So housing could pull back or slow down from the crazy price increases or appreciation that we've seen lately. With the stocks have corrected, there's things that are deals, right? So I'm started here by looking at this is Robinhood, right? So you look at Robinhood, you see that Robinhood is, they went public at 35. They've been cut to, less than half, more than half, shall I say. So here at 13, 32. One of the things that about, and so again, this goes back to what we know. There are more, I'll just say here, more retail investors, in the market. And Robinhood ushered a lot of new traders. So you combine that with the pandemic and the more people went to investing between crypto and stocks. And Robinhood is a major player in that market. And so you can say here from a stock correction perspective, if Robinhood, so you can see they put in a bottom right here at $9.95. So even if you just say, if you were to have played that from $9.95 to where we are today, that's a 31% increase off of the lows, right? So that would have been a good trade there on Robinhood. But even beyond that, if you didn't even catch that, you can just see that Robinhood is in this box. And so as long as Robinhood goes sideways, it's fine. If we don't get another big leg lower, we'll see. But I know Robinhood is supposed to be rolling out cryptocurrency trading internationally, and that they're going to start adding some names. And I think they're going to possibly do a true crypto embedded wallet within their platform. And so the number of cryptos that they have, in addition to their stock and option stuff that they already do, this might be a name that's interesting. Let's look at some of the other names that have pulled back tremendously. Now, I'm not necessarily a fan of this. I don't know where this goes, but this is Facebook, right? Facebook has just absolutely gotten killed, right? Last 2 weeks since earnings. So you can just see just from earnings, Facebook is down 33%, right? Could this be, so you look here, you're coming up to this support at 213. Next support level there is 184. And then below that is 151. I don't know if Facebook recovers from this. I tend to think that they will. But, maybe one you want to look at. Now, I would say this is a risky play because I'm not sure if, what's going to happen. Or it could be, a value play of a lifetime. I don't know which way it goes, right? Let's see. Look at FedEx. Okay, you can see FedEx is down. Good company. Either FedEx, Home Depot. FedEx down 27%. I said Home Depot, I meant UPS. Actually, UPS, you can see here. UPX, they just pulled back a little bit this month. This past week. But you can see, their chart looks better than that FedEx chart. So, but again, they're down a little bit off of the highs, not much. Let's see what some other bargains are. This is one we missed. Well, I won't say we missed, but we talked about these when Visa and MasterCard was getting pulled down along with Square, PayPal. Visa and MasterCard, they bounced off these lows and they went up. Whereas if you look at a PayPal and a Square, they've just continued to go lower. Whereas MasterCard got that bounce somewhere in January, as well as Visa. They got that bounce, right here in November. And they came off of the lows, whereas Square, PayPal, let's look at the PayPal. And PayPal, they just kept going down. So we're here, Square and MasterCard, they got that bounce right here in November. And then they shot back up, where you can see Visa, PayPal and Square, they just continue much, much lower. And that's the difference between, if you look, we kind of had some of these conversations. You look at the PE here. So the PE is reasonable now, but before, what you're talking about, almost 3 times. That'd have been like a $99 PE versus now is at a respectable 33. But what you see what you had to get there. Whereas if you look at a Visa and you compare, yeah, they were going down, but you can see their PE was 38, and it would have been even lower when they was getting crushed. And so that's the difference between a growth stock and a stock that's with a high PE versus one with a reasonable PE. So going back to what we know, these stocks have corrected. So the idea is when we go back and you look at this long term. So if I pull this back up here, all right, and pull that back over. So good companies, and let me move it to the other side because it keep going away. So you say you got good companies, long-term view, and what we know is that stocks have corrected, right? Are these some good values that you can pick up some shares of things that have pulled back? So you got Microsoft on a little bit over 10-12% pullback. You got Nike on it's about 30 points, and what is that? Measure it out. Can't do it in my head that fast. So 21% pullback. Qualcomm chip maker, they haven't even really, they pulled back a little bit, but not much. You can see here they had earnings doing well. Now just take that whole thing we talked about, long-term perspective, right? 5 years, look at where Qualcomm is. They were stuck in a range for about 3 years, and then but from here, from 19 to where we are today, from what is that, 46 to 164, that's 400%, right? Talked a little bit about Visa, but again, long term. So some of these stocks, they have corrected and they're giving you some opportunity to get in. So I'll stop there. Any other comment to this long term discussion, or any other comment, if not toward long term, just in general? But what are you all doing? That's really what I want to know. What are you all doing during this time? I know Barry said he's sitting on the side. David said that he's playing more crypto. Brian, what are you doing?
At the moment, I'm sitting, but I'm just trying to figure out which way I want to go next, to be honest with you.
Okay. What you looking at? What are you considering?
So, so like I do have some of the banks now. And I actually have Visa, and I'm debating on, do I just float in more on those guys, or do I do a little bit more risk? So like you mentioned Facebook, so I've been watching its fast decline, and so I've been debating on when and if to hop into that puppy. And so
okay
and then I do have Newmont. I noticed you guys stay away from the golds and silvers, but I just can't help it. And so I have Newmont, which did a nice little pop yesterday. I can't help it.
Is it NGT?
NEM.
NEN.
M.
Oh, NEM. Okay.
Yep.
All right, got it.
Can't help it.
What was that laugh about, Milt? Huh?
That was me, by the way.
Yeah, that was me.
Oh, that was Barry. Oh, I thought that was Milt. Go ahead, Barry.
Oh no, I was gonna ask Milton, do you ever, since we're in a bear market, are you shorting the stocks?
Okay, I'm eating right now, so let's come back to that.
Okay, I got you.
All right. Let's see. So Barry, you chimed in. What are you doing right now? You just hold. Oh, you said you were just sitting on the sideline.
No, right now, I'm doing long term, more like swing trading. So I think that's where I'm better at, like doing day trading, trying to pick a stock that day and then sell it that day. I don't think that's working. Okay. So what I'm doing is buying good companies that I can hold if things don't go right in the swing trade. But right now, this week has been kind of, flat.
Okay.
So I'm just waiting to see what the market gonna do this week coming up. But it look like some good deals out there. But right now, I'm just waiting to see. Are we gonna be in a? Go ahead.
Yeah. So are you? So it's funny because I thought you were more of a long-term trader, but sound like a long-term holder, but sound like you're doing more trading. So let me ask you because if somebody would ask me, say, well, what kind of investor trader is Barry? I say, well, Barry, he like dividend stocks. He like income related stuff. So I wouldn't have thought that you were a trader. I thought you were more of a long-term holder.
No, I am a long-term holder, but my thing, I want to make an income. I already got, my situation, my job is long-term. So I'm trying to make income. So okay. I'm not thinking about long-term plays because I got a long-term play working at a job. So
you're just trying to just
because I got a pension, because I got a pension.
Okay, so you're just trying to build capital now.
I'm trying to build capital, leverage the money and make money off. I'm trying to make income, produce more income.
Okay. Well, so given the discussion that we had earlier around the dividends, does that appeal to you in that income discussion or not really?
Oh, yeah, it does.
Okay. And that's interesting because it's because I thought that would be something that you would see and be like, oh, I can use that, and it kind of fits in, with the kind of passive income, style that I know you have. So yeah, I thought that would have.
So the thing is, I don't have a 401k, so I don't want to. I'm playing like with my personal money, and I don't want to be subjugated to losing that money. So I put my limits in, and I only set a certain type of risk I want to lose. Because me losing 30% on my money, unacceptable. So,
well, but it's interesting though, because even as I hear you say that, so like if you look at a T, right? So this is a AT&T, right? It doesn't go up, down, doesn't go up, but or go up or down that much per se. I mean, this is, I don't know, maybe even I say that's probably 30-40% move in terms of just this general area. So yeah, it's like a 30% general area, but they pay a dividend, right? So if you go down here, you look at this yield. So this yield on, so you're talking about 8%, right? So that 8% yield is something that, you could play, and you don't have that much volatility, and particularly where you are just looking at this chart here, going back, you can see here, anytime we get close to this 21, it's an area. So probably, I guess you had a chance here back in December. But in this though, I'm just bringing this up to say that this is something that you can play in this area, buy down here, and then hold it, and then get that 8% yield to give you that quarterly income that you're saying that you're looking for. And again, you don't have to play that risk, as much of that risk. You see what I mean? Now, where if you bought up here in the 30s, yeah, that's too risky to buy up there. But you can see kind of where we're down here, much better on the chart. So
right. Deal.
So like that one, that AGNC. You can look at this one. This one pays dividends monthly, and you're talking about a 10% dividend yield per year. So if you say 10% over 12 months, you're looking at probably about 0.75. So we're around in there. A yield per. So what is that? Let's see. We should do the math real quick. So you're talking about 0.83. Yeah. So 0.83 times was at 14. What's that trading price? What's that? 1405. Yeah. So you're talking about so 1405. So you're talking about what, 11 cent? Yeah, about 11 cent per share per month. You know, so that would be what your yield is on that. So you can definitely get some income coming in there. So go ahead.
No, I'm listening.
Yeah, so just hearing you talk, he's like, hey, I don't want to risk a whole lot of money, and I want to be able to earn capital. It seems like the dividend play, because dividend plays would be an area that you would want to look at. So just kind of hearing your style. Let's see who else here. Deke, I ain't heard from you that much. What you rocking with, and what you looking at from some of your plays, Elder Lorenzo?
I added a little bit to my Home Depot and Lowe's, because I'm thinking it's getting ready to be spring season. So I just added a little bit more into that. But other than that, I'm pretty much sitting still on the rest of them.
Okay. Home Depot and Lowe's. So yeah, so Deke, that's makes sense. So with your real estate background, you say springtime is coming, folks are gonna be buying. Well, let me ask you, what do you think about these interest rates and how it's going to affect the housing market, and particularly, mortgages and stuff that you do?
It's already affected the pricing already, because it's costing an arm and a leg to keep these rates down. But I think the Feds will probably go up a quarter. I don't think it's going to go no higher than a quarter when they do increase the rate.
So you think this first one is just going to be a quarter percent?
Yeah, it's not going to be nothing drastic from what they've been telling us. Probably about a quarter. Now, it may go up a couple of times during the year, but starting out, the first one probably go at a quarter.
Now, let me ask you, what if they surprise the market and go up 50, half of a percent versus a quarter of a percent?
Yeah, that's going to shake the market up if they do that. Yeah, it's already scary right now, but if they go up a whole half, it's going to be a whole new ball game.
So do you think that's going to slow the price appreciation down on the houses as well?
That's what they're betting on. We got these economists that come and talk to us and everything. So they're betting on it, because right now, the appreciation just going crazy. Just, every day, properties are appreciating.
Wow. Okay,
let me throw in really quick, because what you said is vital. They're going to crush that. I can 100% guarantee you, by whatever means possible, they're going to crush that. Because as you remember back to that financial bubble, this is what started it. And they are not going to let that happen again. So I'm leaning toward maybe not a surprise, because there's already talk of a 50%. So they may, if you start hearing more and more talk of that, that they're finna get really aggressive.
So to that end, Milt, what are your plays off of that? Are you still? I know you're talking about the bank. So Wells, J.P. Morgan, Morgan Stanley. You're still loaded up, in anticipation of that.
Oh yes, I am deep into Wells Fargo now.
Okay.
I'm also buying Sophie. Every time it dips into the 11, I buy Sophie.
Oh wow, I didn't know they got crushed as much as they did. I didn't realize SoFi was. I don't have it on my. Let me add it to my watch list. So SoFi, they came public back here in November at what, 10? It looks like like $11. You can see here they're only within $1 of their IPO price. But you can see here is that in these last 4 weeks, you can see the volume has picked up tremendously in this name. So there are a bunch of people that want this and they think that they're getting it. And again, it's, so if you just chart this quickly, you can see kind of where we are, right? So if I take the very top.
Mike, really quickly,
yes, sir.
Just in case anybody's stupid enough to listen to something I'm doing, this is like 5 years. I am not selling. I don't care if it goes down to 1. And I already have did my homework. So that's why I am buying this stock. And if you don't do your homework on stock and you listen to somebody on the internet, you're going to be in for quite a bit of pain. So let me just throw all that out.
All right. So give us a little bit of the thesis and what the research has uncovered.
Okay, I'm going to just give you a short part. 1, it's going to become a bank. You know I love banks right now. Number 2, it has grown quite a following of young people. And I follow young people because that is a good way to get rich. Young people doing it, you want to invest in it.
Okay. Just that simple?
Really, the stories are when you buy a stock and you're expected to soar, if you have some deep thesis about all this stuff that's going to happen, you're going to probably be in for pain there. The stocks are really simple, like Apple. They are making a great product. It's just that simple. And they're making a lot of money from making a great stock. I'm saying that these financial products that they're putting out is going to make a lot of money. And they already have just that built-in cult following going along with it. So that's for me.
Okay. Interesting. Yeah, so for those that don't know, SoFi, they started out as initially they started out as refinancing student loans. I think that's when I first heard about them. I'm not sure if what their marketing products and services were prior to me hearing about them, but that's when I first heard of them. And then I think that they just started to expand, and so they have many more offerings now. And so, but that's the extent of what I know. What other products do they have now, Milt?
Okay, they're going to be a full service bank, and they're getting into crypto too. So, I mean, everything. They are one of the reasons you see them getting killed like this, because you could lump them in there with Square and PayPal. Mm-hmm. Mm-hmm. And now they're getting a little bit more like very hip Wells Fargo.
Okay. Interesting. Now, one of the things I see here is that they don't have any earnings yet. So that's one thing. So there's definitely growth. They're in the growth phase. Still, young company and definitely young to the market. But I don't know when they haven't been out for a very long time. So, okay. Interesting. What else you doing? Oh, I'm sorry. Go ahead.
Today's theories. What do you guys think about like the online car buying guys like Shift and Carvana?
Love them.
Yeah, it's crazy. I remember when CarMax came out a long time ago, and I was like, man, that's a good business, and I think they're gonna do well. And it just took them a while before they did. But you look here at Carvana. Carvana has done well, coming off these lows of $24 pandemic to $376. Man, it was a monster trade. But to see where they are from here, just kind of in terms of the pullback, they're down. Now, this is a classic scenario. What we've been talking about is that this is a growth. They have no PE, so they don't have any earnings. This is just pure growth, right? So they're trying to get to profitability. I don't know how close they are, but right now they're still not profitable. And, they pull back 64% because of the rotation out of the growth stocks to more value. So, but you got some other ones like Car Gurus, Car Gurus, they've done a bit better. Well, they didn't. Let's see how much they pulled back. So the pullback off the lows, 27%. Well, not even that, because from the lows they hit 27%. But you can see, actually, this is pretty interesting. So let me go to the daily. So you see, when we first started talking, we were saying that this week we got to pull back Thursday and Friday. But you can see here that they put in lows back in January, first around the 24th, and then again around the 28th. But since then, they had like 9 or 10 straight days up until we got Thursday and Friday's pullback. So Car Gurus is doing well. So you can see they established a new base here at this 28 level versus where before that prior base is 23. Here's a company. What is it called? I actually found it. Go ahead.
There's one called Shift that I couldn't. I'm debating between that one and the Carvana one. I don't know if you guys got.
Is it Shift Technologies?
Yeah, if you got a weighted thought on between the two.
I've never heard of Shift. I've heard of Carvana. I've never heard of Shift. And again, I can just look at this until it's a growth. They're getting killed, and they don't have. Well, I guess they got negative earnings. So they had earnings at one. Well, no, they don't have any earnings. They don't have any earnings. So until now, it's cheap. I just don't know enough about them. Have you seen a commercial?
No, I hadn't. Just when I was looking at Carvana, they have two. Yeah, exactly.
Okay, so let me show you this other one. Since we're talking about cars, it's no, it's not Car Gurus. What's the name of that? Oh, LDI, not LAD, Lithium Motors. So this is a company I found. I was looking for a car early last year. So I ended up coming across this company. And so they have I think a string of dealerships or whatever. And so they sell a lot of cars. I had never heard of them before. And I don't think they're in the Georgia area, but I came across them and found out they were public. And you can see here, just in terms of what they done off the pandemic, 51 to 416, which is crazy, Ryan. But you can see here they pulled back. We're down about 24%, and they were down as much as 33%. So you can see that they've actually come out okay. So you can see they reported earnings here, and earnings numbers were good. Now, and here's one of the things: this is not a growth stock. Look at that PE, 8.5%. So this is a value play in that space. So if I were comparing any of them now, but you can say, Mike, it's a $315 stock. Yeah, stock wise, but when you look at the value, you're getting 8 times earnings, PE ratio versus those other ones don't even have earnings. So this is I think a safer investment, but at least put it on your watch list, do some research on it. But since you're looking at those cars, and then again, kind of going back to the earlier discussion we had, you can see here they pay a dividend. Now, what that yield is, what is the yield? I'm not sure. Let's see. So 35 cent. So it looks like they 35. So that's 70 is 140. What's that? $1.40 over, what's that? 3.15. Okay. So yielding, it's not even a percent yet, 1%, but they are paying out a dividend. So,
Mike, blow back in on that stock, because I think it's telling you something right there. And
in terms of just the chart?
Just the chart.
Yeah, chart wise, you can see that. So a couple of things. One is like if I just draw, let's go here, peak to trough, right? So this is what is called a Fibonacci chart, right? So you can see here, we come down. They went right below the 50% retracement and hit the 61.8, and a little bit lower here. And you can see that they bounced. And so that's one thing. Another thing is you got decent price support here. So if you go back to these November 20th area is where they had support. And then they just start building this base to the side, right? From November all the way through February. And then they came out with earnings, right? So this is a jump up off of earnings. So a couple things. One is that they built a base for a few months, coming back to a previous support point. You can see this downtrend they're in, but anytime we show these downtrends, we're looking for a break of that downtrend line, and we got it here on earnings. Now, the question becomes, what happens over the next few days, right? Or the next few weeks? Can it continue to hold this area? Because we got two things working in your favor. You got this support point here, in addition to the breakout of the downtrend, and you're coming off earnings. So from a chart perspective, I can see that you can possibly build out as a base here. So my first thing would be to look at it. If let's say if I was going to buy this and I'm just trying to find a price entry, I will wait to see if they just continue to go sideways. If it breaks down and it gets back here, I'll probably start nibbling at the 285, just from a pure chart perspective. With the I don't know what the right word is. The understanding that you could break down to this 269. Now, you don't have any. The lowest it got here is this 274. So even if you wanted to make this box a little bit bigger, I'll just draw it down to there, and I would say, hey, the lower bottom of this range, if you get down here, you may want to pick up a little bit more, but you would have to definitely pay attention to this 270, just in case if it broke, that low. But anything in this box, it's probably worthy to start picking up some if you're trying to build a position in this name. And that's just pure, just what the chart is telling me. So, what do you think about that, or what do any of you all think about that? But that was specifically to you, Milt. Could you ask a question? What did you see in the chart?
Exactly what you saw. It looks like if it can hold, that looks like a good investment right there. And I can see it going all the way. That's a long stretch all the way back up there. But once again, we're in a bear market. So I have to make sure that I pay reference to the bear before I enter a stock trade like this. Because I could easily see it going all the way back down there again after earnings. But that's another thing I look for, is when something has earnings pop up like that and do not go back down. So, I would wait a little bit, see what it's going to do, and then try to ride it all the way up to, I don't see what that other bar is. I'm sorry, that's a little tight for my screen.
Right here. Oh, okay. That's 321.
Yeah. So that'd be a nice little ride up.
Okay.
But, like I said, if this was not a bear market, I would be in this stock right now. I'll open a position on Monday. But this is a bear market, so I have to be a little bit more patient and see what Wall Street thinks.
Based just off the chart, but so let me ask you, does this 8.5 PE come into the equation of if we were in a regular market that you would jump on this? Do you factor this into your equation, or are you just looking strictly from a chart perspective?
This one is only chart, nothing else. Because you brought this chart up, I saw that.
Okay.
As it comes to PE, a PE is meaningless to me.
Okay.
Because they may not tell you the real story. Sometimes it's cheap for a reason, and it's going to stay cheap and maybe get cheaper.
Yeah. Now, I would take the other side of that. I think PEs are meaningful when you're in a risk on, risk off, or risk off to risk on, depending upon which side you're coming from. So in this case, where we had a pullback again from the Russell small cap stocks, PE were meaningful because they sold everything with high PEs and they rotated into things with lower PEs. So I think that, in seeing that rotation, and if just look at your portfolios, what were your portfolios in November versus where they are now? And if they're down significantly, then you were probably in growth related stocks versus being more in value type stocks. And that rotation was absolutely brutal. So I take that PE into consideration because that rotation again was swift and it was violent. So and I got the scars to prove it. So it's now again, and a lot of this is based upon this Fed talk and these interest rates as well. So I think that makes a difference. But yeah, Brent, I hope maybe you can add this in just as something to keep an eye on. And it maybe too expensive for your blood in terms of the cost of it from a pure share price, but maybe not so much from a valuation standpoint. So.
That shouldn't be a factor now. I mean, when you can buy a fractured share, a cost of a stock, you should be able to buy Apple or a Google right now. You can get a fracture of it if you think it's going to go up. Cost of percentage, it's a percentage. If you put $100 in there and it goes up 10%, I mean, what's different than buying a stock that's $10 that goes up 10%?
Good point. It's funny you would mention stocks that had earnings. So Google came out with earnings here on the February 1st. And so in after hours, the thing ran up big time. And then the next day you see you got a high here of 3,026 and they pulled back. So kind of what Milt had mentioned before on that earnings of what we were just looking at on the LAD. We're saying you want to see what happens over the next few days after earnings. So even here in Google, just using this as an example based upon what he said, looking at this to see where it was going to track after earnings. And this thing has just gotten, it's down 11% off of that, back down below before the earnings report. So it's almost like the good news that they had on the earnings report. They gave all those gains back here on Google. One of the things too on Google is that Google came out with in this earnings report, they announced that they were going to do a 20-for-1 stock split. So, and I think that's supposed to happen sometime in June, July or something. So, and this is a stock I have been watching for a while. And so just keep that in mind in terms of this Google stock split is coming. Any other things before we jump off? But thanks Deke for that commentary as well on the mortgages and the interest rate discussion, because these housing prices are just absolutely crazy. The stuff I look out and see that they're asking for houses it's incredible for what they're asking for some of this stuff. So
yeah, see, that's one of the reasons. I'm sorry, Brenda, please go.
So you can go ahead.
Okay, like I was saying, that's why start thinking about 50% rate. Just look and see what the Fed, they're not going to surprise us. You're going to see one or two coming out and start talking 50%. And then when you hear all the talking heads start saying they're probably going to do a 50%, then that's when you know. But I can 100% guarantee you they will kill this housing market. It is too detrimental to this inflation that we're having now. Coupled with the housing prices, they cannot let that go, and they will not.
Yeah. So what's your how many raises you think we get this year, and what you say the aggregate total is for the year. Milt, what's your prediction?
I try not to predict that because I know exactly, the factors that are going in that's driving this up is one, Wall Street getting into housing and making those prices go high. I know this because one of my friends have been trying to get a house and people making cash offers. Give me a break. How are you going to compete with a cash offer?
Yeah, you can't.
So that got to be Wall Street. I refuse to believe that there are so many Americans with that much money I'm going to pay pure cash for my house.
And you're absolutely right. Wall Street is the culprit out there that's making those cash offers. They are doing it.
Interesting. So, but think about that though. So we go back and look at, because I had not considered that before, but let's go back and look at something. So if you see here so let's just take the S&P as a barometer, right? Go back to January. So say from January, you got this big correction S&P, right? And if you look at the Russell, you got this correction from November, and then for the Dow, correction from January as well. So if Wall Street is buying up these houses, right, then what they're doing is they're taking this money that they've made on this run, and they're reallocating it from the market and putting it into housing. Then it's just a part of the rotation, right? So it's going to be interesting to see that if this game becomes over because of all of the growth, they're just looking for the next growth strategy. And if they believe the growth is in the appreciation of the housing, then and it sounds like that's what has happened, because we've seen these housing prices appreciate tremendously over the last year or two. Even much more accelerated than what it was already doing. Then that's pretty interesting. And actually that could spell bad news for the markets in general. And then you throw the Fed on top of there raising these rates. I don't know. It's gonna be interesting. It's gonna be interesting. But if they overreact and kill this market, I don't know. That's gonna be interesting as well. All right. Any other comments before we jump off here? Anything? Positions? Order types? Anything with your particular portfolios? Any question, financial related or otherwise? All right. Well, again, thank you all. I appreciate your time here. And we'll do it again next week. Y'all have a good week.